an allocation to private credit can deliver positive outcomes for SMSF members. Alan Greenstein from Zagga is with me today to discuss this idea. Welcome, Alan. Great to see you.
Thank you, Darren. Pleasure to be here. Thank you for the opportunity.
Look, why don't we go right to the basics? How do you define private credit?
Yeah, thanks, Darren. We define private credit as commercial real estate debt. In other words, to us, private credit is non-bank funding of an asset which is generally a property asset, or at least is secured by an asset made up of real physical property. There are other kinds of private credit. There's consumer lending, there's business lending. Much of that is unsecured. But in our space, we're talking about commercial lending secured by a property.
And if we look at the SMSF space, you actually did some research into the sector a few years ago. What did that reveal?
Yes, we did some interesting research, I think in around 2018, a couple of years after we started. And what that revealed at that point in time, and I think it's probably still largely valid today, is that most self-directed investors, in other words, most SMSFs, SMSF trustees, and single investors invested either in the most conservative risk category or the most risky risk category. In other words, if you kind of think about a barbell in a gym, there's a metal bar, and either side of the metal bar are two big weights. The left-hand side is your most conservative, least returning investment, say a bank deposit, maybe a savings account, could even be a current account. And on the other side is the riskiest investment you can think of. Not quite betting it all on red in the casino, but it could be venture capital, could be some kind of private equity, some kind of other kind of riskier venture. I'm not saying that they're bad. I'm just saying that on the risk spectrum, they're at opposite ends of the risk spectrum. And that middle ground, what we kind of termed the middle ground, that middle ground was largely ignored by self-directed investors, by SMSFs. And our proposition since day one has really been to populate that middle ground. In other words, take a little bit more risk, not a lot, but make a substantially higher return without actually minimizing the left-hand side or the right-hand side of the barbell. Still make decent returns with the aggressive stuff, cap your downside perhaps, but populate the middle ground a lot more.
And what you're saying is obviously that's where private credit can actually play a role within an SMSF portfolio.
Yes, we actually think, Darren, that private credit is the most ideally suited of the alternative investments to fill that gap in the middle. And there are a few reasons for that. The first reason is that it is still a cash or near cash annuity type investment. In other words, the investor is not investing in equity, they're investing in debt. So they're getting a debt type return. They've lent somebody the money, I don't know, $1 million at 10% per annum for 12 months. That is a very certain, very transparent investment. The borrower knows what they have to pay back. The investor knows what they're getting, and there is no volatility. It's not subject to any changes in stock market prices. It's not subject to inflationary pressures. It's not subject to cost of living rises. It's not subject to extraneous market conditions. It's pretty certain and achievable and realizable over that period of time. So for the fact that it is not an equity investment, that it's counter inflationary, it is uncorrelated to equity markets, and it's safe and secure, we think that's a great investment for an SMSF.
Now, to this end, Zagga has made available an avenue for SMSFs to private credit through the CRED fund. Can you tell us a little bit more about that?
I'd be very pleased to, Darren. Before maybe I explain the CRED fund, let me explain that Zagga started its first fund in around 2019. That fund is called the Zagga Feeder Fund. The CRED fund is a direct proxy of the Zagga Feeder Fund. So although the CRED fund is a little bit newer than the Feeder Fund, it looks and feels exactly the same. The only difference between the two is that the CRED fund is a unitized fund, whereas the Feeder Fund is a fractional fund. And the reason we made the CRED fund a unitized fund is to make it easier for financial planners and third-party advisors to invest their SMSF customers via a platform. So that fund is available on most of the major platforms. It's not on Macquarie at the moment, but it's on the others. And it just makes it easier. But between the feeder fund and the cred fund, there is no real difference. Now, with that in mind, that fund is a commingled fund. In other words, an investor's money is mingled with all the other investors' money. And that money is then used to invest in the underlying Zagga loans, of which there are currently $800 million worth. Zagga has lent out over $1.8 billion worth since it's been going. It's repaid $1 billion. So that fund has got a small portion of the 800 that's out there. And that fund is invested across 57 loans. So there is a lot of risk diversification. There is no concentration risk exposure. And that fund is currently paying a return of about 9.43% per annum to investors, payable monthly. Now, of course, if an investor doesn't want the monthly return, they're welcome to reinvest and get the benefit of the higher return. But the cred fund is an ideal opportunity for an investor to be invested in a basket of underlying Australian property secured loans at an average loan to value ratio of 63%, earning 9.43% per annum with monthly distribution. Compared with what they're getting in the bank right now, that sounds to me, without giving financial advice, without telling anybody what to do, but that's quite a compelling investment proposition. And I certainly put my SMSF money in that product.
Now, Alan, earlier in the conversation, you mentioned commercial property, but I was wondering if you could shed a little bit more light and a little bit more detail as to the underlying assets of the fund. And maybe you can tell us also what the minimum investment amount for the fund would be.
Thank you, Darren. I probably should have spoken about the composition of the fund and of commercial real estate debt a little bit earlier. So thank you for reminding me. Let me deal with the easier question first. It's $100,000 minimum investment into a direct Zagga loan, into the Zagga feeder fund. And if you wanted to go into the cred fund, it's a $50,000 minimum investment. So those are really the three categories. Now, in terms of where is the fund invested, it's easier for me to begin by saying where the fund is not invested. So we generally do not do agricultural land. We don't do specialized assets. So we're unlikely to do a hospital. We're unlikely to do a brewery. We're unlikely to do an engineering plant. Those are things which are just difficult to sell, have a very small pool of potential buyers if something had to go wrong and we had to get out of the asset. Our biggest exposure and our biggest investment is to boutique style and smaller style commercial, residential, mixed use assets. A few examples of that, let's say in New South Wales, in the Shire, along Brighton and the Sands, along Miranda, Sutherland, anything that would perhaps be a couple of floors of basement parking, 1 or 2 floors of retail commercial, and up to 30 or 40 units on the top. That kind of would be good use of mixed use commercial residential. Then we do a few industrial and type assets, so some mini factories, some mini warehouses. We have some of those in Bowral area right now, Southern Highlands, some of them in the Newcastle area, etc. We do not do high-rise apartment blocks. We do not do high-rise office towers, but we do some boutique stuff. We have a small office tower in Collingwood in Victoria, which is going to be sold as strata for a very strong developer. And I think we're busy funding right now the tallest building in Newcastle as an office tower, which will be 7 stories. So those are the kinds of things we do. Our average deal size is somewhere between $50 and $40 million. The average loan term is between 3 and 24 months, or the minimum and maximum terms are 3 and 24 months. The average term is around 14 to 16 months. And as I said, the average LVR is 63%. So, you know, investors can actually drive around the suburbs of the eastern seaboard of Australia, and they can see the assets going up.
Now, I know you're not issuing any sort of financial advice, but I was just wondering, as far as portfolio allocations go, is there a rule of thumb that SMSF investors might look towards as to what an appropriate ratio of allocation to private credit might be?
Darren, that's an exceptionally good question, and not being a financial planner and not wanting to give investment advice, I don't know the real answer to that, but perhaps let me give the answer that kind of I was taught when I was much younger, and which I've always lived by, and that's generally having around 30% of your assets in cash around 30% in equities of some kind, and around 30% in other hard property, real property, etc. So let's assume that we're dealing with the 1/3 roughly cash portion of an investor's portfolio. I'm certainly not suggesting that an investor should put all of their eggs in one basket, but an investor should certainly, especially if they're fully invested only in the bank right now, they should think about getting a much higher return on the cash portion of their allocation without touching the other 67% of their portfolio, but just on that 33% of their portfolio. Let's say they had to put a half to a third of that in private credit type investments, such as with the Zagga, such as within the cred fund, earning a significantly higher return than even if they're keeping the rest of their money in the bank. They're simply going to average up that return, and that's going to be a good investment for them. So I'm in favor of an investor not keeping all of their eggs in one basket, spreading their risk, but certainly making their money work for them. So I would be working with that 30% cash portion. Obviously, if all of your SMSF money is in the bank, which we still think that 70% of the money is, then you have a slightly more complex problem in front of you, and then you've really got to allocate assets across those first categories, and again, not put all of it in another one basket only, but diversify to make sure you're managing the risk and getting the optimal return. So that's quite a long answer to a simple question, but 30, 30, 30, and of the 30 that's in cash, diversify into other kinds of products like private credit.
Okay, Alan, well, thank you very much for those insights. And again, I thank you for your time today.
Darren, a pleasure to talk to you. Thank you for the opportunity.